Welcome to hackertrading.com. This is Hari Swaminathan. In this video, I want to cover the concept of non-directional trading. We saw in the previous video that an iron condor is a non-directional trade, and I've kept this trade on right here to show what we mean. So first of all, in a non-directional trade, your delta is going to be very close to zero. So it's going to be almost zero. And of course, you can never probably get it to exactly zero, and that's not the point either. If you have a very small delta, whether it's positive or negative, it doesn't matter. So here what it's saying is if Apple moves by $1 up, our position, our profit and loss will go down. We'll see a loss of about $5. So that's not a whole lot, and that's exactly what a delta neutral position will be. So in all delta neutral positions, what you're going to see is you're going to start off delta neutral. And the reason, this iron condor starts off delta neutral is you can see that it's almost right in the middle of this range. In fact, it's a little bit closer to the call side, and that's exactly why you'll see a negative delta, because this is negative delta is a bearish position, and because this is a bear call spread, you're going to see a slightly negative biased position. But in general, that's what you're going to see. You're going to see very close to delta neutral. And that's the point, because when you take up a delta neutral position, what you're basically saying is that you don't want to predict whether Apple's going to go up or down. Your strategy doesn't depend on Apple either going up or going down. It doesn't matter which way Apple goes. And that's the great part about non-directional strategies. You don't care how Apple moves. All you care is it doesn't make a huge move between now and the expiry series. So the iron condor is a great example of a non-directional trade. Let me show you a couple of more non-directional trades, and then we'll come back and discuss the characteristics. See, one of the most important characteristics of a non-directional trade is that it's going to start out non-directional. However, as Apple moves, because Apple's not going to stay at 575, it's going to move. It might go to 560, 550, or it might go to 600, whatever. So as Apple moves, you're going to see that your delta is also going to change. So you're no longer going to remain delta neutral. So you can see here we have three lines. These are simulation lines. So if Apple went up by 10%, then we have a negative delta of 24. So it's gone from a negative delta of 5 and it'll go to a negative delta of 25. And that's because it'll be very close to our bear call spread, and therefore the bear call is going to have a higher delta. Similarly, if Apple goes down by 10%, then we're going to have a positive delta of 23. So the point is your delta neutral position, your non-directional position is not going to remain non-directional. Whenever the stock moves in either direction, you're going to start becoming delta biased, whether it's positive or negative. It depends which way the stock moves. So that's the thing you have to watch for. And in terms of an adjustment, at some point when if Apple moves by, here we can see that if Apple moves by $20 to the downside, we're not facing a huge loss. You can see the white number, it's about $40, $50, $60 loss. Similarly, if Apple moves up by $20, $25, we see a slightly larger loss here because it's approaching our bear call spread, and we are already close to our bear call spread. So these are the intricacies of each of these strategies, which obviously we cover in detail on each strategy's individual courses in module 6 and 7. But this is an example of an iron condor as a non-directional strategy. Now I'm going to take this off, and I want to quickly show you a couple of other non-directional strategies. One of them is a calendar trade, and the calendar trade is what we call a time spread. So a time spread involves options from different series. So if you see here, the July series has 23 days to expiry. The August series has 51 days to expiry. And what you're really trying to capitalize on is the fact that the July series is going to decay. The time decay in the July series is going to be much more than the time decay in the August series, because the July series is much more closer to expiry. And we know that options lose value on an exponential basis. So what we can do here is we are going to buy a calendar, and usually a calendar is done at the money. So if Apple is at 575, at the money option is going to be at the 575. We are going to buy a calendar. So now that we've put that on, let's see what the trade looks like. So we are selling the July, 10 contracts of the July, and we are buying the same 10 contracts of the August. And what this does for us is, because the July, we are short the July option, so which means time decay is going to be in our favor. And you can see that the net position has a theta value of $38. So we're going to gain from this position of $38 a day. And if we look at the risk profile of this position, and that's what a calendar is. Now, again, you'll see that the delta of this calendar when we start out is fairly delta neutral. It's got 11 deltas, 11 positive deltas, but you can see that if Apple moves by 10% on either side, now you're getting a serious delta in your position. But right now it's going to start as a non-directional position. So you don't care which way Apple moves as long as it doesn't move too much. So if it doesn't move too much, what you're going to see is a time decay element, and I'll show you just like we did in the iron condor. I can show you how time decay will affect these calendars as well. So, we go to July 4th, you can see that we immediately have a profit of $385 in 1 week itself. So because in a calendar, especially with the strike prices and the option prices that we've chosen, you have a much higher time decay. So now your theta value is almost $71 a day. And if we move it by just another week, you can see that you have a nice profit of about $1,100. So that's how, and you can see the white line is also moving up nicely into your profit zone above the zero line. So that's when you want to see your white line move above the zero line. And in any options position, that's what your goal is, to make sure that the white line moves above the zero line, because that's when your position is profiting. So anyway, so this is how a calendar is structured. In general, we put a calendar also around 50-60 days to expiry. So July series, which has 24 days, is a little too close. We'd probably do a calendar between the August and the September. So that's as far as the calendar. I quickly want to show you a straddle as well, because straddle is also a non-directional strategy. It's also another favorite strategy. And in a straddle, what we do is we buy a call as well as a put. So now you might be thinking, what kind of a strategy is this? Because a call, when you buy a call option, you're bullish, and when you buy a put option, you're bearish. So how is this going to make money? And that's the fun part of this trade. But let's just put it on and see. So in a straddle, what we do is we are buying a straddle. So we are buying 10 contracts of the 575 call option, and we are buying 10 contracts of the 575 put. Now here you can see that you're buying two options. So you have a very serious time decay issue, because time decay is going to be working against you in this case. But let's look at the risk profile of a straddle. And that's the risk profile of a straddle. Because you've bought a call and a put, you don't care which way it moves. But in this case, what you want is, you want the movement to happen quickly, because time decay is against you. So every day you hold this position, you're going to lose some value because of time decay. But you can see that as long as if Apple moves up by a lot, then your calls are going to make much more money than the puts will lose. And if Apple moves down by a lot, then your puts are going to make much more money than what your calls are going to lose. And that's how this strategy makes a profit. So again, we start off in a delta neutral. We don't care which way Apple goes as long as Apple makes a move. So, in your iron condor and your calendar, you did not want Apple to make a huge move. In a straddle, you want Apple to make a huge move. So it depends on your outlook. So if there is some, either an earnings event or some other event coming up for a stock, you would in general, and you don't know what the outcome is going to be. If that event results in a positive outcome, then the stock's going to go up. But if the event results in a negative outcome, then the stock's going to go down. So in that case, you don't know which way it's going to go. So, a straddle is a great strategy for that kind of a situation because you don't care which way it goes as long as it goes by a lot. And that's when the strategy will profit. But what you have to watch out for in a straddle is the time decay element. So anyway, we cover straddles in 2 courses as well in module 6 and 7. If you have any questions on this, please drop us a mail at info@hackertrading.com, or you can leave us a comment on this page. Thank you.